why would anyone want to make their grantor trust defective on purpose? So now let's go to what are intentionally defective grantor trusts. And just as an acronym, they're also known as IDGTs, IDGT, because it's obviously a long word to keep on saying. So Peter, maybe you want to jump into what are they?
Yeah.
Or let's start with the basics of what are grantor and non-grantor trusts.
Yeah, so an IDGT is a type of grantor trust. It's worth explaining what grantor trusts are before we get further into IDGTs. So a grantor trust is basically a trust that's ignored for income tax purposes. It's treated like the taxpayer themselves. So it's like a single member LLC. You report it on your own 1040. Sometimes they file their own very short 1041 tax returns, but basically they're totally ignored for income tax purposes. And so if a grantor trust has income, it's reporting its income on your return. An example, a lot of grantor trusts that you probably encountered in your day-to-day, if you have a revocable living trust, it's definitely a grantor trust. So that's an example of a trust that's totally disregarded for income tax purposes. There's a bunch of other types of trusts that fall into this bucket, but the basic idea is a grantor trust is a type of trust that for income tax purposes is ignored.
The other example that I sometimes use in here is there's obviously revocable trust, which really anyone who's looking at this type of estate tax planning should have a revocable trust, but there's also similar to a single member LLC, as while it's an entity that exists, it's really a flow through entity where the tax liability, the assets are still owned by you. Even if nominally the trust is on the ownership name, it all does flow through and sit on your tax return.
And then the non-grantor trust is the alternative to the grantor trust. It's a non-grantor trust is a type of trust that is treated like a separate taxpayer for income tax purposes. So it's the paradigmatic trust, pays its own taxes. It gets deductions when it makes distributions to beneficiaries. And it could potentially be located in a state that is different than the state that the grantor lives in. So if you have a client in New York State, they could set up a trust in South Dakota, which doesn't have an income tax, and that trust could be a South Dakota taxpayer. But to do that, it has to be a non-grantor trust, because if it were a grantor trust, it would be based in the same state as the client for tax purposes.
Yeah. And the more, I think, piece to call out here is that from the IRS's point of view, these non-grantor trusts are effectively a taxpayer. It's like me or Peter. It has its own EIN. It files its own taxes. It has its own unique tax rate that is separate from yours. It has its own situs. So what Peter is saying is Peter lives in California, but if he had a non-grantor trust that he's a beneficiary of or the grantor of, that could be sitused or based in South Dakota and face South Dakota state taxes instead of California state taxes. And one of the advantages is for people in high tax states, it is one way to arbitrage state tax rates. We'll get into that later. But this is really more of those are the two contrasts. And now we'll explain why would anyone want to make their grantor trust defective on purpose?
An IDGT, the G in IDGT is grantor. So an IDGT is a type of grantor trust. So for income tax purposes, it's ignored. But unlike your revocable living trust, it's not ignored for gift and estate tax purposes. And so what happens is you make a gift to an IDGT, it's outside of your estate. So it's separate for gift and estate tax purposes, but it's still treated like a grantor trust for income tax purposes. It's still reporting its income on your personal 1040. You're still paying the taxes on it. So it's disregarded for income tax purposes, but not for other purposes. And the defect is referring to this sort of inconsistency between the rules for income tax purposes and the rules for gift and estate tax purposes. They never quite line up. And so this is a way of trying to get the best of the income tax world while also getting the benefits of what's called a completed gift trust for gift and estate tax purposes.
I think it's a really important piece to call out is what defines you as a grantor trust for income taxes and estate taxes are two different things. And essentially this trust is structured so that it is a grantor for income tax, but non-grantor for estate tax purposes. And the purpose behind this is to really help you thread the needle to optimize estate tax planning. And we'll jump into why this is so powerful, but I think important context is correct me if I'm wrong, Peter, IDGTs are the most popular estate tax planning structure that's used.
Yeah, it's no one keeps numbers on this, but it's probably the most common estate tax vehicle out there. Super popular, very easy to maintain, and very flexible. So
Let's maybe give this kind of overview of, we talked about what's this key feature, but
Yeah.
we'll go into why that's so powerful.
yeah. So actually, the next slide, why that's so powerful. Briefly, because the trust is treated like E for income tax purposes, there's a bunch of stuff that you can do with it that can be very efficient from an estate tax perspective that would otherwise generate income tax liability if the trust were a separate taxpayer. And so a bunch of neat features, which we'll talk about in the next slide.
Yeah, and we jump into that probably now. I think probably the most salient point to call out here is the reason you use an IDGT versus a non-grantor trust. One of the most common distinctions is you're going to use both if you're over the lifetime gift exemption. But the more you are over the lifetime gift exemption, the more powerful an IDGT can be to minimizing estate taxes over time. Yeah. And this is where I'm sure everyone here knows who Mitt Romney is, knows he's a very sharp and well-resourced person. This is why it's like, again, we talked about, it's probably the most commonly used trust structure for this. Mitt Romney used an IDGT for him and his family and his future heirs. And this is just, we're not going to go super deep into the detail, but it's just a little bit of, this is what people do when they're trying to mitigate estate taxes and are significantly over the lifetime gift exemption or lifetime estate, their estate exemption.